All right, good morning, ladies and gentlemen. Today is Wednesday, August 14th, 2019, and it's time for another edition of the Investing Systems Trading Service live show. And boy, is this market getting exciting these days, right? We've seen a lot of significant moves down, up, all over the place. There's a lot of news going on, lots of crazy stuff. It's been sort of a wild August in the market. So here we are about halfway through August and everything kicked off with the Fed announcement, right? You guys remember that? I was actually doing the live show the day that the Fed announcement came out, and the funny thing is that everybody was sort of expecting that the Fed, well, the expectation was obviously that the Fed was going to cut rates. The question was whether they were going to cut by 25 or 50 basis points, right? And they called it a mid cycle adjustment. There's the day. And so prior to that, actually just a few days before that, here you go. All-time high in the history of the world for the S&P 500 and bumped right up against that trend line, which to me is quite frankly it's amazing, right? Because typically with technical analysis and trend lines and that type of thing, there's a little fudge factor there, right? I mean, the trend lines never seem to work perfectly, and a lot of times you get a trend line that the price pokes over it, or you'll get a support level where the price pokes below it and then bounces, and so they're kind of, I think it's somebody said, maybe it was me, maybe it was somebody else said once that drawing trend lines with a crayon's probably your best bet because they're basically just sort of guides that you go with, right? Like a guideline, right? But typically they're not absolute. Well, in this case, it's just amazing how absolute this trend line seems to be, given the fact that if you draw it across, and you guys remember, I think you guys probably remember the fall of 2017. I mean, the market just went absolutely parabolic, right? Absolutely parabolic back here. And let's see, what day was this? This was January 3rd. Okay, so I guess it was like December and then into January. But in 2018, so on January 3rd, the market broke out here and just ran straight up. And as I recall, there was a bunch of articles coming out that, hey, this is the best January, in 15, X amount of years or whatever. And that bodes well for the rest of the year, right? The old Wall Street adage is that, so goes January, so goes the year. Or, if you have a really good January, the year turns out great and stuff, right? So that's one of those old Wall Street adages. Well, we know how 2018 turned out, right? It was down 6%. So, I mean, the S&P 500 literally closed down 6% for 2018. And so that particular old Wall Street adage about, best start to a year didn't work out last year, right? And the funny thing is, the reason I'm talking about ancient history over here is that, all of a sudden now all the talk is about the yield curve inverting and low interest rates and negative $15 trillion of negative interest rates around the world and all this. And so the market's getting kind of spooked here because yield curve inversion, which you're going to talk about all day long on CNBC, is generally a harbinger of an upcoming recession. Data came out last night from Germany and China that basically shows that those two economies are not doing so well, and so there's a lot going on. And the funny thing is that here we are, and we're still just sort of in the midst of a little pullback here. And yesterday was kind of wild. We'll talk about that in a minute. But going back to what I was saying earlier, back over here, interest rates were rising, right? Interest rates were like the 10-year yield was about 2.5%, and it was sort of looking like it was going to go to 3%, which it did. And that, as I recall, rising interest rates back here is what caused this big sell-off that started. I can go back. on my chart here and just zoom in a little closer. But yeah, market just literally went parabolic. This little particular run up here in this January is, you always hear them talking about, oh, the market won't go down because there's no euphoria, right? That was, as I recall, that was about the closest thing to euphoria in the market that I've ever seen. Just persisted almost the entire month. Then you had, right at the end of January. This is end of January 2018, right? So you had interest rates started to rise, and that's what spooked the market. And boy, did it sell off quick, right? I mean, it was there was a markets in turmoil special this day, and then another one this day, like almost back to back on CNBC. You got a huge bounce here, and a lot of chopping around. This sort of V reversal. Whenever you get one of these V bottoms, everybody thinks, "Oh man, the worst is over." This and that. And the longer it sort of persists to the upside, you get half the people think, "Okay, the worst is over," and then you still get the retest the lows camp. Right? Every time you get a big sell off and then bounce off of it, there's always a number of individuals that think that, okay, we just need to retest the lows. And so anyway, but the funny thing is that, so rising interest rates, the yields on the bonds going up is what spooked the market back here, right? And so now, we've had a lot of crazy news and stuff lately, but all of a sudden the market's getting spooked because of dropping yields and all this negative yielding debt around the world. And now all of a sudden today, the twos and tens have inverted. I mean, there's been a few of the different interest rate, what I'm trying to say, parts of the curve have inverted, but for some reason the twos and the tens is the one everybody watches. And like I say, because throughout history, um, it doesn't predict every recession, but it's sort of one of those things that people will point to and say throughout history, right before a recession, the yield curve inverted on the twos and tens. And so that's sort of, and I've actually heard of and seen some mechanical market timing systems that basically that's a signal to get out, right? Like when the twos and tens invert, and so now it becomes a matter of time. I already saw this morning that I think that they were no longer inverted or whatever. So, and of course, the Fed can is expected to cut rates in September, but boy, they've really painted themselves into a corner, so to speak, because the inflation numbers that came out yesterday were much hotter than expected, right? And so inflation's already, they're already concerned that inflation's at their 2% target. It's actually running a little hotter than that. And so now they're really in a pickle. And the funny thing is here is that this was the last time that the Fed hiked rates, right? Last fall, and then market kind of hung around for a little bit, and then it tanked. I mean, this was a 20% sell off from intraday high to low. They didn't really talk much about it because it was just under 20%, but it was pretty brutal. And then, of course, the administration did everything in their power, like down here at these lows, right around everybody was focused on Christmas, right, and Christmas and New Year's. But literally, Mnuchin was making phone calls to the PPT and banks and stuff. And I mean, they were freaking out on this sell-off because it's 20%, right? And somehow or other, they managed to turn that sucker right around. And the funny thing is, so at the beginning of this year, right, had this massive sort of rally, and then right here was like the first little sort of dip, right? That that ended up at about, let's just call this, 27, 25, right? This first little dip. And of course nobody was, after this run up and this little pullback here, and nobody was really crying foul or thinking, hey, this thing's going to come unglued. Although, that would have been a good spot for it to sort of roll over and retrace a bunch of this move. I mean, that was a humongous move, but And so then, hey, another leg of the rally. And so this whole thing, and this correction right here that we had in May, it was brutal as far as individual stocks go. It was a brutal correction. You can see that it came all the way back down to roughly that, 27.25 level, right? Actually, the low was 27.28, but I'm just using round numbers because it makes it easy to remember. So you can clearly see this humongous line of support right here. And nobody was really panicking here, obviously. And, this was, I believe it was about a 6.8% correction. And nobody really seemed to be panicking there. It was kind of a weak market or whatever. And then, magically turned around, went up, made new highs. But what I'm getting at here is that, based on, there's July 31st, Fed lowered rates quarter point. The next day, Trump the next day, the market looked like it was going to come up and hit a new all-time high, right? Because this is the all-time high in the history of the world up here. And then Trump threw cold water on that by announcing additional tariffs on China. And then ever since then, you've had all sorts of weird stuff. Like, in here was the Chinese currency devaluation, right? And so that kind of spooked the markets more. And then you had China say that they were going to Chinese companies said that they weren't going to import U.S. agricultural products, and then boy, that's between that and the devaluation of the currency. That's where you got this big drop right here, and of course, that's where CNBC did their markets in turmoil special, and then so basically at that point, let me go to a different chart here. Let's see if I can figure out which one I want to go to. Yeah, this is a good one. So. Yeah, so this like really quick sell off here pretty much caught everyone by surprise. So the Fed rate cut turned out to be a sell the news event, but look what happened here is literally in like 4 days the RSI, which to me the RSI is one of the best indicators you can use as far as like sentiment, and obviously it's the market being overbought oversold. But when that RSI gets down to around 30, under 30, you can typically expect a bounce, right? What's interesting is when the market pulled back here, the first little dip that we had, no, it was only a couple of percent, but the first little dip we had, look at how the RSI went right just sort of to the midline here. I have this midline at 50, right? And so no big deal, not oversold, and so it stayed pretty much in overbought territory. Then it got pretty much overbought here, and just because it gets overbought doesn't mean it can't stay overbought for a long time, and vice versa. But generally speaking, you get a sell off where you hit 30 or you poke through 30 or whatever, there's a bounce coming, right? And so, and again, there can always be like, a flash crash or, another sell off or whatever. But anyway, so, we got our bounce, and there's still a lot of sort of bad news out there, right? And so what I'm looking at here, and let me go back to my real clean chart. What I'm thinking here, and see, it doesn't really matter what I think, right? Um, and for very good reason. Like what we're doing here is our back end system is, obviously you guys know this, is totally impartial. It's a piece of software that chooses stocks, and it calculates different levels and entry points and all this stuff, but it's totally impartial. It doesn't know what the market's doing or care, right? And so that's a good thing, because basically there's been so many times along the way, like right back here. This is a great example. Like right back here, when I was doing the shows, I was like, oh, we just had this huge rally here. It would only make sense for the market to, like, give back half of it and sell off or whatever. And I mean, everybody was still sort of shell shocked from the sell off in the winter. And so there was a couple of spots along here where you would think, okay, man, this thing's just rebounded so significantly that it can't possibly keep going. And so, my judgment didn't mean anything, because the system doesn't care about market conditions or geopolitical tensions or the inverted yield curve or the Fed lowering rates or Trump tweets or anything like that. it's basically just going to go about its merry way and keep doing what it does best. Although it does, I'm going to say that a lot of what it does sort of has like this little magic touch where it adjusts for, and I would say like that, the going back to the RSI, it will adjust, right? When the RSI gets too overbought, it's going to start paring back on certain things, and when it gets oversold, it's going to look for opportunities to get in, and then and it's not strictly based on the RSI. It's sort of just built into the system that it has like a self-correcting type of thing. So here's my point: is it's a long way down to here, right? And nobody was really, there wasn't much drama here. And quite honestly, this particular, what they call a, garden variety technical correction, little sell off, whatever, there was not a whole lot of drama here either. Although a lot of stocks did get crushed, the level of drama in the media was minimal. And so, I mean, here we are just, I mean, yesterday, right? So yesterday, you guys know the story, right? Trump came out and said that he was delaying tariffs on certain products, delaying, additional Chinese tariffs on certain products like computers and electronics and that. And man, that just lit a fire under the market, and literally in like 10 minutes, the whole market just surged up, right? And then for the most part, the rest of the day it went sideways. So it happened really quick, and then you're looking at all your charts, and what you see is sort of this pattern where you get a sell off and a bounce, a couple of down days, and then a big sort of, there was tons of like bullish engulfing candles yesterday, and then so we bounced up, closed this gap and that, and then today's the day where the other shoe is kind of dropping because I think that everybody's the fears of a economic slowdown are back, and so really nasty gap down, and so this is some brutal price action. So the point here is let's look at the Russell real quick, and then I'm gonna dig in and start talking about some of our stuff. But Russell 2000 is in an interesting spot, and I've talked about this on the show numerous times. But this particular trend line goes back like 9 years, right? And it's another one of those. It's another like rising trend line drawn across the highs going back. That happens to fit on a monthly and a weekly chart. And again, it's just uncanny how the market, the Russell 2000 anyway, IWM, how it ran up there, right, last year. And basically in the fall, it hit that rising trend line, tested it again, and I'd have to go to like a weekly or monthly chart, but that was basically it, right? And then of course, it sort of led the market to the downside in the fall. But this bounce here, like the bounce starting this year, with the Dow going back up to the highs and the Nasdaq back to the highs and the S&P back to the highs, the Russell, which is obviously 2000 stocks, you can see what it's doing here. It's kind of, it's not really had the kind of performance that the other major indexes have. And quite frankly, when they refer to it on TV, they talk about the three major indexes. That doesn't include, the 2,000 stocks in the Russell, the smaller caps. And so it's really, for years, has been my primary gauge of risk appetite and how sort of broad the market rally is and that type of thing. And so, with the Russell 2000 kind of just trading sideways there, and I mean, you can go back to, we can go back to like 2017. The Russell's gone nowhere. Been a lot of volatility and price movement and that. So we're in kind of a little precarious spot right now because what's happened is that the actual S&P, like the index, is kind of outperformed your typical stock, and so the nature of the market is that if the S&P pulls back 5%, your average stock gets hit 10, 15%, maybe even 20%, and so these dips can be kind of brutal. our system is adaptable in the way that you choose to trade along with it, right? And so this is kind of the point that I'm making here is if this market sells down to here, right? Like if that's going to happen, and there's a lot of uncertainty out there, and it wouldn't surprise me one bit to see this thing sell down to here. And I don't know, that would be a huge big deal, right? And of course, that's not going to happen quickly, I wouldn't think, but that level, 27, 25 or whatever, was really not a huge big deal either of these times. And quite frankly, you know, 27, 20, if I extended that all the way over here to January, when we were running up here, and in December of, well, I guess that was the very beginning of January, when the market hit, that level over here, man, it was bullish as can be, right? And you can see that there's a lot of time was spent at that level, and so it's just funny, on the way up, 27.25 was throw a ticker tape parade down Wall Street because the market's going up and hitting new highs, and then on the way down it's a scary level, and so we're still there's a little bit of symmetry on this chart here. So the really interesting thing is going to be, and I obviously had a trend line drawn from the low to here that got broken. Everybody had that same trend line, but it might make a little sense right now to draw this trend line across the lows, right? Just because that's a pretty good fit. Like this is sort of a nice near-term trend line, and boy, I mean we've seen so many like 1% moves lately that I don't think anybody can really guess accurately what the next direction is, because you get these big sell-offs, right? And then a day later you gap down and then you get a big rally. And so anyway, that trend line right there is the one to keep your eye on, right? You violate that trend line, and then there's a pretty good chance you could come down and test this level. And then obviously huge support. There's good support here at like 28.20, and so it's going to be interesting. One thing I will say is that we've had a pretty rough August here. Stocks, CNBC's headline says stocks tumble as Treasury market sends recession warning. Well, of course, you're going to hear everybody say that typically when the yield curve inverts, that you don't see a recession every time, and if there is one, it's 12 to 18 months out. But you're also, consider this, that right now the U.S. economy is in the longest expansion in history, right? Like the longest expansion without a recession in the history since they've been measuring it, I guess. And so a lot of things, I suppose, the Fed, the last Fed meeting, Powell said that what they're trying to do is keep this expansion going as long as possible. But I don't really believe that the Fed has the ability to repeal the business cycle, and therefore, you could probably say, hey, there's gonna be a recession at some point in time. They're just trying their best to forestall it, and so lately here, and especially today, it's just looking more inevitable, right? And so, generally speaking, and over the past few years, I've heard a lot of people say that, hey, unless there's a recession, stocks will be fine, right? Well, guess what? If people start thinking, if there is a recession, then stocks typically don't just pull back a few percent from the highs. And so we haven't had a recession in so long, and the last one was so brutal that I don't think anybody knows what'll happen. So anyway, so going back to leading up to, I should say, what all this discussion is about is the fact that in a tough environment, in a really sort of, the type of environment we're in now, our system gives you the flexibility to say, hey, I'm not going to load up load the boat up with a whole bunch of stocks, and maybe I'm just gonna, maybe I'll just pick like one or two, or or one here and then see what happens, or maybe three. Doesn't really matter, but the idea is that you go to the calculators page and you use the old strategy where you say, okay, I'm only going to risk, I'm only going to risk 1% or 1.5% of my portfolio. And quite frankly, in an environment where the market's like could go either direction, and it feels rough or whatever, you say, hey, maybe I'll risk 0.5%, and still participate. In theory, you could, here's the thing: is like with all this turmoil, right? You know that we went for days and days and days without having any open trades, right? Like the open trades that had done pretty well got closed when they pulled back to the trailing stops, and so we had some good winners. We had one full stop out, like just one full stop out, I believe. Back a week ago, and so it basically, it closed everything out over earnings and over the little bit of turmoil we had, and then so the market started to stabilize and bounce a little bit, and that's always the that's always like the toughest part of the cycle. There is when you get a significant sell off and then you get a bounce. You don't know if it's going to be like we've seen in the past, one of those V reversal type things where if you sit there on the sidelines, you just get left in the dust, right, and end up chasing. We've seen lots of those over the years. Or you get like sort of these quick rallies that suck everybody in, and then the market reverses and tanks again. And so we could be looking at that again. And of course, these individual stocks are more volatile than the overall market, and so that's the but anyway, what I'm getting at is that the way to sort of counteract that, and like I was saying before, me thinking that the market was gonna roll over, and then it did the absolute opposite. So the only thing you can do is sort of you know, use what you're seeing or thinking or whatever to adjust how aggressive you want to trade, right? And so I just want to look at these because these particular stocks, they triggered last night, right? So let's just take a look at. Let me go to my other screen here so I can pull these up because I haven't marked these charts up yet. Figured what we do is, well, take a look here and just see what we're looking at here. Costco, big brand name stock, nice uptrend. The trigger for today, 275.25. Let me just figure out where that is on the chart because there's something 275.25. Oh yeah. What I was about to say is that so it just barely poked at that. So this is officially the way that the system works here is that closed above the trigger price yesterday, and so it automatically gets dumped onto the open trades table. However, if today the price never actually traded over the trigger price, then it would get removed from the open trades table. Like it wouldn't have actually triggered. This one triggered by a few pennies, right? Let's see, 275.36. So 11 cents, right? So by 11 cents, this one officially becomes a trade. Now, here's the thing: is that so you see the market, gap down this morning and all this. Um, yeah, and plus this is an expensive stock, and so you may or may not have wanted to jump right in this, like right at the open, especially seeing this gap down, right? And so this would be a good one. This is a great one to. Obviously, Costco is pretty decent, pretty decent. If this market turns back around, obviously this is just probably going to keep going up and work out. And so the idea here is that you can use your discretion. You don't have to jump right in. And maybe in the coming days, that particular trigger price is still going to be valid, right? So, I mean, just at this point, things could still go either way. The idea of the system is that you have a stock in a primary uptrend, it has a pullback, starts reversing, and it's held up pretty well. But yesterday was sort of an anomaly, right? Because the whole Trump thing and the trade war is why we got these big, that big move up there, and so everything just got sort of carried along with the market, and then of course today you're seeing the opposite, and so may or may not want to give it a little time to settle down. It's going to be interesting. It's going to be interesting to see how this little part of the cycle plays out. As long as I'm over here, I'm going to mark the stop. And that's something else I wanted to talk about for a minute too, because let me just mark this stop on here. So the initial stop. Yeah, I figured I was looking at these last night and I figured, hey, I might as well wait until today and just mark these things up here, and that way we could kind of take a look at them together and see what they look like. Initial stop is 267. What I was about to say, and I'll show you a great example in a minute, is whenever you see that initial stop and you're thinking, oh wow, that looks really far away. This particular one, I mean, it kind of looks normal. It is based on the ATR, right? And so this ATR has been sort of picking up here. And so the last 14 days or whatever, the 14-day ATR. Let me just see what that is here. The 14-day ATR on this thing's 543. That's pretty significant. That's well over 2%. But, back here, and we use a monthly ATR, by the way. We calculate our system calculates its own sort of unique ATR using an entire month where we drop the biggest and the smallest off of there, and then we take the rest of it, and we actually get a lot sort of better ATR than just using the 14 day. So, and that's what we go off of. It's kind of like a hybrid. Now, of course, I could change this to a 30-day ATR, which brings it down a little bit. But the longer your ATR goes, it generally gives you a better idea of the type of range that you can see on a day-to-day basis. So anyway, besides that, what I was about to say is that this stop this stop can like move up to here tonight, right? Or depending on what the price does today. If for some reason, the market rallies a little bit, this went up. If over the next couple of days, my guess is if this were to come all the way down towards yesterday's low or the previous day's low, this stop's going to stay here. If over the next couple of days the price, stays sort of in the upper end of this range, this thing will move up quickly. And so I'll show you a good example of that because I've seen some where some of the open trades since, I guess, like since last Friday when we had some trigger, a lot of those stops have already ratcheted up significantly. Now the only sort of downside to that is that when you get like a bounce like this and then you get a sort of another sell off, if the stops come up too quickly, which sometimes they do, then they can get tagged pretty easily. But the bright side of that is that it's for, a very minimal type of stop out. So, 2-3%, anything in like the 2 to 4% range as far as a stop out is literally nothing, and especially if you're risking a very small amount, which should be on each trade, and adjusting that based on the environment. So, lo and behold, Apple has a trigger price of 204, right? And so this is kind of the perfect situation. And here's the thing is like with this kind of volatility that we're seeing here, with the kind of volatility that we've been seeing lately, you're going to get these scenarios where, back over here, right? The system had calculated 204 as a trigger price, which would have been, which was kind of a great entry, especially if today would have been like a big follow up day, right? So, but as we suggest, we wait for a we wait for the price to close over the trigger price, in which case, it closed way over the trigger price yesterday. So coming in this morning, um, like say it opened here at two, where it closed yesterday at 209. You're thinking, oh man, do I want to jump in, $5 over the trigger? Well, that's entirely valid if you add $5 to the target. So let me put the target on here. Target's only 215, right? And so basically what happened here was that what happened is, and you see this happen on occasion, where you get a stock that closes significantly over the trigger price. And so just say it would have opened here and you'd have jumped in. Basically, you just add the difference to the target. Simple as that. And so let me mark this on here while I'm here. So, but this is an interesting situation. Target 215, trigger 204. Whoops, what did I do? I screwed up there. Trigger 204. All right, this is a really interesting situation here on Apple because, and here's the thing: Apple's kind of I won't say a proxy for the market, but it's the most widely held stock on the planet, right? And so goes Apple, sort of so goes the market. And obviously that doesn't hold true at all times. This was the earnings release, right? This is pretty crazy, right? Apple came out with earnings, huge gap up all this, and then of course, that was the same day, if I'm not mistaken, that was the same day the Fed, well, it was the 31st, the same day as the Fed announcement, and then Apple came out with earnings after the bell. But huge move and then down. So anyway, here's my point: is that this is your perfect sort of situation, right? Because if you were looking at this late last night, you're thinking to yourself, "Oh man, I don't know whether I should buy $5 over the trigger price or not, and that's valid too. If you see a stock that, and of course you got to do the percentages. You can use the calculators page to do the percentages, but if you see a stock that just blows through the trigger price or whatever, and then the next day gaps up or something, you may just want to hold off. And like I did do a blog post over the weekend. You guys might want to check that blog every now and then. On the regular website, there's a blog, and basically what I was sort of getting at on the blog, and I wanted to reiterate today, is that it's perfectly valid to set a limit order at the trigger price. If you like one of these stocks or the setup or whatever, instead of just jumping in blindly the morning after it closes over the trigger, we've seen a lot of times, and especially with the type of volatility we're seeing now, perfectly valid to just set a limit order at the exact trigger price and leave that in there for a few days because we're seeing a lot of up and down price action. So something like Apple, it could have gapped down here today and then dropped, right? Like suppose it opened here and then dropped down there. Um, you know, on that in that case, it would not have been an open trade, but sometimes if it opens above the trigger price and bounces around a couple of days later, it'll 2 3 days later maybe it'll come down and tag it, so it's still valid, put it that way. So anyway, so the strategy today would have been: it opened below the trigger, you hold off, and then as it pushed up through the trigger, once it got above 204, then it becomes a valid trade. So it seems to be kind of hanging in there okay. I mean, the S&P as I speak is down 2%, right? So it's gonna be interesting to see how this plays out. Now, before I get to the next one, I want to mark the stop on here. Stop is at 195.60. The stops always are going to start off kind of, based on the ATR, and the idea is to give this thing initially, anyway. Initially, give it enough wiggle room so that that's like some normal volatility and normal pullbacks, not just going to knock you right out. But the thing of it is that that stop's probably going to come up relatively quickly. And that's another thing to pay attention to. Like, of course, everybody in this, every swing trader says, well, you got to have a 2-to-1 risk reward ratio or a 3-to-1 risk reward ratio, right? And so this seems a little counterintuitive, to begin with. But what you got to keep in mind is that, couple of days, if the price just like hung around here a couple of days, right? Boom, that stop's going to come up here. This stop's going to come up quickly, right? And so, like I said before, if the price starts to make a move up and this stop comes up to here, and then you get a big sell-off day or whatever, it's going to get you out with a minimal stop. But so don't get hung up on the 2-to-1 risk-reward ratio because like I say, the stop's going to come up so quick that literally in like a few days you will be looking at a risk reward like that. So it's just basically, set up so that the initial stop is kind of at a level so that we don't get knocked out. What we don't want is to take a full stop out. Full stop outs are extremely rare too, because and they will happen. There will be full stop outs, especially when you get sucked in on an up move and then the very next day the market tanks. But that's just sort of the nature of the business, right? So you can look back here, the last trade on Apple, it gapped over the entry, had a big run up, and turned out to be a really nice trade, right? The stop, and I didn't draw like all the stops on there, but you can see the trigger back here. It gapped over a little bit, pulled back towards it. So if you were using a limit order back here, you would not have gotten filled. But we had a little bit different of environment, right? We just had a major sell off, a perfect pivot low, and then a reversal. And so this day right here, that was a pretty valid day to jump in. And then of course, the system didn't quite stay in for the whole ride because that trailing stop went up so quickly. So anyway, that was the last trade here. So this one still looks fairly reasonable. Um, we'll have to see how that plays out. If you were ever, if you like to trade Apple or whatever, trading along with like these swing cycles that our system calculates is probably one of the actually one of the good things. Let's look at this EDU here. This is another one that's had some really decent trades in the past. It looks to me like, yeah, we've had some really good trades in this. There was one back here, and then there was this pullback, and then got a little sloppy here, but triggered in, hit the target. So both the past two times that we've had swing trades on this stock, it hit the target, except for this one. Um, I didn't. Oh, this got. I know what it is. This got closed ahead of earnings. I'm gonna mark that on there because closed ahead of earnings. That's what that was all about. So we had the trigger here, and then it kind of had about a week or whatever. Didn't quite make it to the target. So check it out. We closed it ahead of earnings. Boom, there was the earnings reaction. I always talk about, hey, we never hold a stock over earnings because. But here's the thing: for every earnings gap up that looks like that, you get one in the opposite direction, and so it's just there's no way of knowing which way it's going to go for earnings, and so you have no risk management, no control. You know that there's going to be a big move. You might as well just not risk it. So the thing of it is, if you had five stocks that you held over earnings, you might get one of these. You might get a couple that did nothing, and then you get one that did something like this in the opposite direction. It's either a wash or it ends up it ends up worse than you expected. So just not worth risking it. So anyway, this one's triggering again. And let's see, the trigger is 104.90. Now this is going to be an interesting one. I'm going to show you why. All right, so 104.90 is the trigger price here. Let me get this. Okay, so it's going to move that up just a little bit. Here is the important thing to note. So today, all right, so we got close above the trigger yesterday. All right, there's the trigger, 104.90. Close above the trigger yesterday. It hits the triggered today list, gets put on the open list. But look at this. So today it gaps down, and if this stock, like if this doesn't reverse and trade at 104.90, right? It's not a valid trade. It's not valid. It's not going to trigger, and it will get removed from the open trades list. So, and this is just one example, but in the future and down the road or whatever, keep in mind that the idea, and this is exactly why we do it like this, right? Is to avoid these little fake outs. That's sort of that's one of the brilliant things behind the scenes that Jeffrey came up with, and that really helps you avoid like waiting for the stock to close above the trigger price and then looking to enter the next day as long as it's still trading above the trigger price. That little sort of strategy right there over the long term is going to make a pretty decent difference. And most of the time, I'm going to say the majority of the time in sort of a normal environment, if there is such a thing, and see, we're not really in a normal environment right now. We're sort of in a dysfunctional environment where, the market's making these, 1-2% moves on a regular basis. There's, so much, Trump says something and the market goes up 2%, and then the next day, some geopolitical or, something like a yield curve inversion. I mean, there's a lot of crazy stuff going on out there, right? The news cycle has been crazy ever since the Fed meeting in August started. And so anyway, my point here is that in this situation right here, this stock is not triggered yet. And so it would be valid, like, and I'm not using this one as a case, but just in general, like, in general, if you like the look of the chart or you like the stock or whatever, well, this is the perfect situation where you could place a good till canceled buy order at the trigger price and give it a few days and see if it gets filled, right? This stock, tomorrow it could. I don't know what it's going to do today, but tomorrow it could open. In the next couple of days, open somewhere, and then boom, huge long range bar up here to a new high, right, or whatever, and so you get filled on the way up. So this is sort of a perfect example of where you'd use that, where you could potentially, I should say, use that limit order. Just kind of there you go. Look at how it closed yesterday. Right, just like basically like right on that trend line drawn across the highs. Now, of course, if this was a candle, if I change this to a candlestick chart, right, then change this to a candlestick chart, I could totally use I could draw like a different trend line on here, right? So that's kind of on a candlestick chart, I might want to draw something more along the lines of that. That looks a little bit better. So anyhow, so here we are. I'm gonna delete these because I don't like. That's why I have these really clean charts here. You'll notice that I have nothing on the chart but the price. And obviously, when I'm looking through stocks, one of my favorite charts is this one. It's got the is it that one? Yeah, yeah, this one with the Bollinger Bands on it. And let's look at the SPX with the Bollinger Bands. Yeah, I got the Bollinger Bands, the 200-day, the 50-day here. Um, this blue line is the 20-day moving average, which is the intersection of the Bollinger Bands. Something interesting here. A little off topic, real quick, but look at how these Bollinger Bands pinch together, like right on Fed day, right? If Let me see if that's in here. Bollinger Bands width. Check this out. It's kind of an interesting thing. So, the old, obviously, if you've, why does it seem low right here? Huh, that's weird. Bollinger Band's width. Well, anyway, this doesn't look like what I'm used to, but I don't know how accurate the default settings are, but what I was getting at here is like these Bollinger Bands right here were like really sort of pinched together, and generally speaking, after that, you get a really significant move. This was the tightest, like on Fed day was the tightest that the Bollingers have been all year, which is kind of amazing, right? I mean, you just see it, and literally like the price practically hit the high and the low, which is extremely rare. I mean, you almost obviously, it poked through the low. It didn't hit the high, but you almost never see a case where like the 1 day's price action traverses the entire range of the Bollinger Bands. That's extremely rare, and so when they pinch together like that, I believe that sort of signifies a significant move may be forthcoming. That also happened back. Something similar happened back up here last fall, right? Fed day, and you had a pretty tight Bollinger Bands up here. Shortly after Fed day, and then you can see how it broke to the downside, and so we're kind of getting something similar here, right? 200-day moving average, which everybody uses. I don't think at this point here is really a. I don't think the 200-day moving average means a whole lot, just because of the fact it's been going sideways. I mean, generally sideways, right? And so if you were trying to time the market with a 200-day, you'd be getting whipsawed just left and right? Especially like back over here last fall, you had these two breaks above it, right? And then obviously the market, fell. And then just more recently, you had, these two little pokes below the 200-day, and those were buying opportunities. And so, generally speaking, in, a good trending market, the 200-day moving average is like trending and going along with the trend, and maybe you get pullbacks to it or in the vicinity. But what's funny here is that, I mean, the market at this level right here is literally sitting at the same level it was in January of 2018, right? And so if you think about that, that's 18 months of we're in the same spot we were 18 months ago. And so that's why your 200-day moving average is basically going sideways. It's got a slight upper bias to it, but it's going sideways because the market is essentially, big ranges and all over the map, large percentage moves, but it's gone nowhere in a long time. So, anyway, last thing I want to talk about here, real quick, is the open trade in Microsoft, right? Open trade in Microsoft. And so, this is one where the stop literally got moved up overnight, right? And so, if on the outside chance that this comes down a little bit more, this will get it taken out, right? But the good news is that I'm going to calculate this percentage here real quick. So I'm going to pop over here to this calculators page on my other screen and just do this real quick. So this is kind of, you've heard the old adage, cut your losers quickly and let your winners run. Well, this is how the system cuts the losers quickly, right? Is that it gets that stop up as quickly as possible. So, all right, so check this out. The trigger price 138.35, and of course we know that happened on that happened on Thursday, and so Friday, this officially triggered in here, right? Officially triggered in, and then we had a sell down, and then yesterday, um, yeah, typically you see a day like yesterday and you get some continuation. So this is kind of, this is a lot of volatility on this chart. But um, so now that this stop is at 134.50, the risk is minus 2.7%. Boom. I'm going to make that bigger, right? I'll make that bigger because that's important. 2.7%. And so anytime, of course, hey, Microsoft kind of like Apple we were looking at is obviously one of the stocks that is going to, if the market would have gotten followed through to the upside, then Microsoft's probably going to lead it. And if we're going to back and fill, retest the lows, then this is going to be a major contributing factor. If money's coming out of the market, the rising tide, stocks rise and fall with the tide of the market. And so if this market's gonna end up retesting the lows, then Microsoft's gonna end up down here. But check it out, a 2.7% risk on a trade that that had some decent potential shouldn't bother anyone. And so that's just the nature of the business. And of course, if we're risking 2.7% on the actual trade, and you're risking a minuscule amount in your portfolio, then it will easily be made up for in the next cycle, is all I'm saying. And so if you did pull the trigger on this, now there's cases, and I've seen this before, where like where the stock will pull back and hit the trailing stop that got moved up, right? But it never actually took out the initial stop. And sometimes I think to myself, oh man, should have just left the initial stop in there, and this trade would end up being would end up working. But here's, this is sort of getting back to what I was saying before. Let's see, the target is 143. So let's just zoom out on this a little bit. I hadn't marked the target on here. And so this is getting back to the whole risk reward thing, right? As Jeffrey always says, and I'm hope to get Jeffrey on the show next week. He was sick last week and got behind, so spent a week getting sick, and that put him behind probably 2 weeks or whatever. And so, but I do hope to get he. It would be a good it'd be a nice change of pace to get him back on the show here to impart his wisdom, because he has a way of saying things that are a little bit different than I do. But so anyways, it's getting back to the thing where the risk reward or whatever changes quickly, because say that instead of this being down here today, right, and looking like it could hit the stop, um, say that that we got some follow through and we were up here, then boom, this stop would probably end up here. And so the nature of the stops getting trailed up so quickly is what offsets, like, what some people would say the initial risk reward not being all that great. Although typically on something like this, you're gonna see that the target is more than the initial stop, but not the kind of thing like a 2-to-1 risk reward or 3-to-1. But that's compensated for by the fact that we're trailing these stop ups quick. But if this stop gets hit, it's going to be one of those. It's going to be a good example of the old saying, "Cut your losses quickly," right? And so, getting back to what I said a little while ago, anything in like the 2 to 4%, even 5%, right? A 5% stop out should not be a big deal. The way that I like to think about a 5% stop out is that like, if you made a bet in Vegas and lost and got 95% of your money back, that ain't bad. See, that's not how it works, right? That's typically if you make a bet, you lose how much and you lose what you bet, right? But if you could make a bet and it ends up, you were wrong and you lose the bet. If you get 95% of your money back, well, that doesn't sound too bad. And so that's kind of the way that you want to view, these stop outs. And the market's going to have up cycles and down cycles, and so you got to learn to just sort of roll with the cycles. And just when you think, hey, I'm not buying anything or whatever, that's when the market reverses, and then you get an upcycle. Or if we go into like a real tumultuous sort of environment here, and we get, I mean, there's nothing like a bear market rally where you get like a day or two of like double digit bounces or whatever, and so the system will take advantage of that too. But the real key is just being able to use sort of a mechanical type of strategy and just basically adjust your exposure based on what you're seeing in the market environment. So right now would be a pretty good time to be risk averse. So anyway, if this ends up being a losing trade, you're going to get 97.3% of your money back, right? Can't argue with that. So um, and it is what it is. So anyway, hey, it was an interesting show today. Sorry that I kind of rambled for an hour there, but hey, I mean, it is what it is, right? It is what it is. So regardless of what I think right now, I'm kind of keeping my eye. I'm keeping my eye on that trend line. Um, you're gonna see a lot. You're gonna see a lot of drama if we get down around these lows right here, and it already seems like the financial media is already sort of freaking out. Treasury market sends recession warnings. So all it's gonna take is and I mean they like to when they see the market fall like this, they love to sort of pile on with the bad news and that. So it may behoove you to sort of play defense here for a while. And it's just funny. I mean, it's like a day-to-day sort of whipsaw type thing. But anyway, keep your eye on this. You get down here. This somewhere between here and here probably be a decent buying opportunity. So we'll just have to see. And and here's the thing: if you want to play defense, take really small positions here and there. Um, the idea is that small stop outs shouldn't bother you. If they do, then just sort of hang back and trust me. I mean, the market goes through these sort of cycles no matter which direction it's headed, and so there'll be plenty of opportunities in the future. And well, let's just see how it plays out. So hey, well, thanks for coming on the show and listening to me ramble, and I will see you guys here again next week.